Good morning. Welcome to Bazaar Morning Call. I'm Sonia Shenoy. With me in the studio is Anuj Singhal, and joining us from the sidelines of the Motilal Oswal Global Investor Conference is Lata Venkatesh. She'll be giving us a pulse of what's been happening at that conference, and today being the last day. But Lata, morning, we wake up hoping to see better cues for our markets because last week was not pretty. We saw big FII selling, markets closed at the lowest level since 2014, August 2014. And this morning, when you look at the US data, you get a sense that the Fed faces a very difficult decision because the jobs data seems to be really mixed.
Oh yes, sir. The Fed actually becomes a more important cue this week and next rather than the Chinese markets. But I think there is reason why the Asian markets are rebounding and why the Chinese markets are stable. And I want to draw your attention to the presentations made by both the Chinese finance minister and the Chinese PBOC, People's Bank of China chief, their Reserve Bank chief, to the G20 at Ankara on Saturday. These are very seminal presentations and we have to take them very seriously. At this point in time, the PBOC chief is as important as Yellen is to the financial markets, and this finance minister is as important as perhaps the Secretary of Treasury in the US, maybe even more, because the Chinese finance minister can literally mold his economy much more than any other finance minister. Now look at the statements he made. He says he expects and he's telling the G20 members, the most powerful finance ministers and central bankers in the world, he is giving a commitment that he expects his financial markets to remain stable, that the renminbi is not on a course for long-term devaluation. That's a commitment he gives, and the most important commitment is that fiscal spending by the Chinese government this year is going to increase by 10% against the earlier budget estimate of 7%. Now, a 3 percentage point more of the Chinese economy, which is $10 trillion, is not a small expenditure. So that commitment should be taken very well by the financial markets. And then, of course, he goes on to say that the new normal for GDP growth in China is going to be 7%. A 9 to 10% growth is unsustainable because we have excess capacity in almost every sector. But he is very confident that he will be able to create a 7% growth, and he says that they have already created 7 million jobs in the first half of the year, and already they are able to move from investment to consumption. The early signs are there. Now this was a major solace. I have spoken to the Reserve Bank contingent, and this is seen as very positive by all the members in the G20. Likewise, the PBOC chief, again, the most important central banker today, says that the Chinese stock market has more or less completed its correction. He said that in the past, since June, there has been a 40% decline in Chinese stock markets, and that was because the markets were over-leveraged. Now the leverage is more or less gone. He gave a commitment that because of the tightness created by the dollar outflow, the Chinese replaced it by infusing yuan on a daily basis and therefore prevented a systemic risk. And he went on to say that the yuan US dollar exchange rate is now stable. And this is, I think, very important for the way in which the Asian markets have reacted. Today, if you see red on the screen, it's also because the jobs data has come in weak at 173,000. There are that many doubts that the US economy, after growing very strongly till July, probably saw some jitters in August. So there are growth problems really for the developed countries and for the developing countries because of the foreign commodity prices. But China is a major stabilizing factor today, and I think the markets are responding to that.
All right, so the commitment to spend more money from the PBOC perhaps is causing some relief. That's what we can see on the screen in various Chinese markets. Shanghai is off about 1.5% from the day's lows and now sitting at up about 0.24%. But Anuj, morning, we saw massive selling on Friday, right? There was about, 1,200 crores of selling in the cash market. Overall, for the week as well, we saw lots of selling in banking stocks. Yeah. Do you get a sense that perhaps the worst could be over, or do you think that because of the trend has been on the downside, we could only see lower levels?
Morning, Sonia. I would look at things a bit differently. a bit more optimistically. Let's take a look at the data. If the market has to bounce, it has to bounce from here. There's still a good chance of market creating a bit of a double bottom around 7650. This is the most important support zone for the market. If this breaks, if the Nifty goes below 7500, then you're talking about that near-term bear market accentuating and maybe even levels of 7000. So that's why this zone is extremely important. Now, you say that, we've seen big selling from FIIs. That's a bit of an optical illusion. If you look at the gross numbers, the selling is not because FIIs have sold a lot. The selling is because the buying has come down drastically. If you take a look at the gross buy and gross sell number, there's gross buying of 3,500 crore and gross selling of only 4,800 crore. That's why that's creating this large FI net sell number of 1,200 crore.
There's like a buyer strike in the market.
It's like buyer strike. What's happening is, as I've been saying for the last 3 or 4 days, the market has become technical in nature, and the fall has become technical in nature. The depth is not there.
Yeah.
Any kind of selling, you want to sell even, say, 1 lakh stocks, the impact cost is very high, and that's resulting in lower levels. I'll just give you 2 examples. ICICI Bank was down 3.5%. It only had delivery volume of 200 crore. 200 crore for ICICI Bank, 250 crore should lead to 3.5% price damage after the kind of damage we've already seen. I'm not sure. That's happening because, as you said, it's a bit of a buyer strike. Nobody wants to buy even at lower levels. Similar was the case with HDFC. Only 200 crores of delivery volume and the stock is down 2.5%. So that's telling you more of a technical problem for this market. And why that's important? Because the same thing will work on the way up. If this market bounces back, 300, 400 points on the Nifty can come easy. The issue would be, would those 300, 400 points be sold into?
Yeah.
The market has become so weak that
because we've had evidence of that last week where every minor rally was also sold into.
Yes,
so that could be possible this week as well.
Every minor rally is being sold into. But what I'm saying is that in this market, you'll get a phase, even if it's a bit of a bear market, even in this market, you'll get a phase where there would be a 300, 400 point rally which would not be sold into. And that can come any time. And that would happen because, no one will actually believe that rally. So not too many people would participate. And on low volumes, the market may keep going up. That's a possibility. That could happen in this market. Now, on Friday, one more thing that stood out was, again, a lot of DII buying, 1,100 crores. So that money is still there for our market, and that's not going away anywhere. And if you take a look at the F&O data, yes, there was a bit of index futures selling. But if you take a look at the options data, the ferocity with which, the puts were being bought, you've seen that stemming. You've seen equal amount of puts and calls being bought, equal amount of puts and calls being written. That's telling you that if the market has to bounce back, this is the zone for the market to bounce back. Maybe today, maybe at some point during this week. But if this market does not hold this 7,500 to 7,600, then you're asking for big trouble. And as I said, it would require a lot of evidence for this market to stabilize before you could say that the worst is over.
All right. Well, we will. Okay, Lata, over to you.
Well, I wanted to add that, the markets could also be helped a lot by data. There is a lot of Chinese data due today. Of course, the GDP data adjustment is already out. In course of day, you're also going to get the trade figures from China. As well, you will get the inflation numbers. And likewise, for the Indian markets, you're going to get a lot of data. My sense is that these data could be supportive. And that might mean, a lot of positivity. I'm completely in sync with what Anuj is saying. Today, there's every reason for the global markets also to get talked up by the Chinese authorities, as well as Indian markets, therefore, to find their feet today. I wouldn't be surprised if today we end up with a decent amount of green.
Okay, then we'll tell you what we get to see on the show this morning, and then we'll continue our chat on the markets and get some guests in as well. Expectations for a September Fed rate hike have moved up after a mixed US jobs report. Peter Hooper of Deutsche Bank Securities and Louis Alexander of Nomura will join in to tell us what to expect from the Fed later this month. Also, the 11th Motilal Oswal Global Investor Conference kicks off in Mumbai today. Ramdev Agarwal of Motilal Oswal Financial Services will join in to get us an investor mood check. Vinod Dasari, the MD of Ashok Leyland, has been elected as the new president of SIAM. He'll join in to get us a check on how Motown is faring. Also, top trading strategies are lined up with Sudarshan Sukhani as always. All right, first let's tell you about the US markets. Well, Friday was not such a good day for them. The Dow was down about 270 points. And for the week as well, the US markets closed with 3% cuts. Now, as you know, the latest is that there's been a mixed set of data that has come in. On one hand, the hiring has slowed down to 173,000 jobs last month. But on the other hand, the unemployment rate has now dropped to a 7-year low of 5.1%. So once again, there's uncertainty on what the Fed will do in its September 17 policy. But here are more highlights on what took place